Okay, good afternoon. Can you hear me up the back? Can you hear me? Great. Today's lecture is on market efficiency. It's a concept that it's been around for close to 50 years, but it's still a concept that we struggle with in finance. And I'll give you an indication of this. But just to illustrate the kind of issues that we think about, over the weekend I was preparing for this lecture, and I thought, what do we mean by true value? This lecture is available on the things. If in the next 5 seconds there's not quiet. So, what's the true value of this ticket is the question that we ask. And if you have a look here, so you bought a ticket to an Elton John concert for $5.50. They've got Elaine has saved $1,000, offers all of that for your ticket, but she'd pay up to $6,000 if she had the money. So if you talk about what's the intrinsic value of the ticket, it's not obvious what that is. And the reason I put up that example is to show that in finance we'll talk about a particular definition of value, which is the cash flows. The value of an asset is the cash flows discounted at a particular rate. But that carries us a long way. It's a useful concept, but there's a lot of items, there are a lot of markets where the value is determined by tastes. And the way those tastes are determined, the prices that is sold for people's taste and their capacity to pay for it. And there's no way for us to identify that beforehand. So there's a lot of items. The point I'm making is there are a lot of assets out there that you can't value using the standard theory of finance. Why does this matter? Well, it means that a lot of asset classes will simply be inexplicable in terms of the neoclassical model. So we have, for instance, here we have a painting. Here we have a painting of a dollar note. And here we have Berkshire Hathaway shares, and there's a house. And so which of those concepts are explicable in terms of finance? Let's have a look at the price to which they sell. So the painting has sold for $35 million. The painting of a dollar note has sold for $32.8 million. A share of Berkshire Hathaway is going for $301,000, one share. And the median house price in Sydney is $1.62 million. So of all of those things, we can value these two. These other ones are, in a sense, out of the reach of finance. But not quite out of the reach of finance, because there's an element in which this kind of notion of impinges on finance. So here we have the movie which I saw over the weekend, that it was The Price of Everything. It's not a movie, it's a documentary, The Price of Everything. And one of the points they make is that the things that nothing is valued unless you have to pay a lot for it. And a central feature of this is Stefan Edlis, who's an art collector and a philanthropist, who says there are a lot of people who know the price of everything and the value of nothing. And the point is there's no connection between the price of something and its value. Its value is something that's determined externally or from a different process from its value. He's actually quite an interesting person himself. Guess how old he is? He's 91. He was born in 1925. He lived in Germany. He fled, didn't escape, but he fled in 1941. He heard Hitler speak, and talking on that it comes across. It took a while to sort of realize this is a 91-year-old speaking. Anyway, that's kind of irrelevant. But the point I want to make is that what sells, the way these pictures sell is because they have a narrative behind them, a story. And here we have, this is Wang Wei, who with the billionaire husband has a formidable art collection. And they've attracted a purchase, so these include Modigliani's Nukush, a reclining nude for $170 million. She says, I've been longing to collect one of his pieces. My husband helped me to realize this dream. I believe the work we bought was the best in that series. What makes this judgment is the stories that we tell. The people have a collective story. Now, and this is a deeper point, which I'll relate to investment analysis shortly, but this question about telling a story is more important in a whole range of contexts. So Yuval Hariri, an Israeli historian and sociologist, has pointed out that his thesis is that one of the reasons why humans, sapiens, became dominant is that we were able to coordinate our activity as a result of our ability to believe in things which don't really exist. When that happens, then we're able to coordinate our activities very effectively. So if you didn't believe in money, we wouldn't have a market economy. If you didn't believe in a nation or state, you wouldn't have this notion of patriotism, which allows people to collectively combine something. So it's a book that's worth, it's a bestseller, deservedly so. And so he says telling effective stories is not easy. The difficulty lies in not telling the story, but in convincing everyone else to believe in it. So in this artwork, people are telling stories. This person, Amy Capolazzo, is one of those persons telling these stories about this particular artwork to people who then are convinced and then buy it. So just imagine, so he goes on about this, most things are actually constructs that are a matter of convention. So this illustrates that point I made earlier, man is the measure of all things. Yeah. So how is this related to finance? It's related to finance because when you're trying to convince people of a project, it's not enough just to have the numbers. The most convincing salespeople, the most convincing financiers have not just the numbers, but also the narrative to go with it, to convince it. So in business, so this is Aswath Damodaran, and he's put out this insight. So Aswath Damodaran, for my money, is the most famous, in some sense, arguably the most famous finance professor in the world. I highly recommend his website. It's almost negligent if you don't use this website. It's lots of useful stuff. But, and he's published a book a couple of years back where he points out that in business there are the storytellers who spin compelling narratives and the number crunchers who construct meaningful models and accounts. But as he says, both are essential, but only by combining the two can a business deliver and sustain value. And this is true for not just entrepreneurs, but also CEOs of a company. They need to have a vision and narrative to be able to take people with them there. So you have a narrative, for instance, the agent of this person, Mike Trout, is able to convince people that he's worth $600 million. And then, in fact, you can go on and say that even though he's worth $600 million, he's actually underpaid. So that's the value of a good agent. So that's just a preamble by way of talking about that, just to show the limits of what the kind of theory I'm going to talk about. But the efficient market hypothesis is quite a startling proposition. But let me start off with a definition of what is an efficient market. So this is Eugene Farmer, who in 1970 came up with this notion that an efficient market, what we would call an efficient market, is one that is efficient in processing information. So where the prices of securities reflect the correct expected cash flow, an accurate estimate of the cash flows given the available information, and the accurate discount rate. So in an efficient market, prices fully reflect all available information. What means that if you have a truly efficient market, and the next thing is the efficient market hypothesis. So this seems like a fairly startling point, a definition. Could a market really be like this? And here the conjecture, the hypothesis, is that real markets actually are efficient, is the hypothesis. So that's the definition of it. And now this is the point, that markets actually are that efficient. So in an efficient market, everything, all information, is already incorporated in prices. By the time you get to it, it's too late. So to bring it back to the formula, to summarize what I've just said, the efficient market hypothesis is this notion that in an efficient market, the expected cash flows discounted at an appropriate risk is the correct price. P is what we observe in the market, and EP would be the intrinsic fundamental value defined in this particular way. And so the efficient market hypothesis is the notion that the observed price is actually the efficient price. It doesn't tell you which expected return or which cash flow to use. It simply says that whatever we observe in the market is there. Now, what makes this credible is that markets are highly competitive. So there are mechanisms by which information gets into prices. So, for instance, Daniel Carl, who some of you might have as a tutor, pointed this out to me. He says, to give you a sense of how competitive markets are, a UBS banker spied on the Eurostar neighbour to crack a $15 billion deal. He saw glimpses of secret messages on his neighbour's cell phone. The Lazard dealmaker didn't pay any attention to the dressed-down neighbour, and word of the deal got leaked out. So the point being, markets are hyper-competitive. But by the time it gets to you in the form of an annual report, that information has been digested and probably already incorporated into share price. So, what's the implications of this? So just to put you some context, that we live in a market economy. What we mean by this is that a price is a function of demand and supply. So the price is the clearing point where supply of goods equals demand. So in a market economy, unlike a centrally planned economy, resources flow to where prices are highest, and if prices are too low, resources stop flowing from there. So if there's an increase in price, there's an increase in supply as people respond to that. That becomes an attractive profit-making opportunity, so people produce more to respond to that. But correspondingly, there's also a decrease in demand. So the higher the price, the lower the demand for this. So similarly, you can think of a car park. One of my colleagues as an economist, is no longer here, but he used to say, we don't have a pricing car park problem at UWA, we have a pricing problem. The price is too cheap. That's why there's never a space. If we increase the price, then the demand would fall and there'd be a spare parking spot. There's a whole lot of equity issues about there, but that's the kind of thinking. Right? Thought I'd give you an example you could relate to. A decrease in price will result in a decrease in supply and an increase in demand as more people. So if parking is free, then everyone wants to park there. So the justification for a market economy is that the prices provide the basis for the optimal resource allocation. So parking policy, the number of parks at UWA, isn't responsive to prices because the university administration decides how many parking, and they've decided that they're never going to increase the price, any more parking spaces. Which means that people can't respond by building new car parks, whatever. So that's You could argue that's an inefficiency. But if we had a market economy, prices would be up, and then you might have people building car parks to accommodate the demand. And so the argument here is that prices incorporate more information about value than that held by any person or entity. This seems like, I'll give you a sense of what this might mean with an example shortly. In an inefficient market, then, prices are misleading indicators of value. So what does this mean by prices are inefficient, and why does it matter? So if prices are inefficient, something will have a high price, but it's actually not worth that price. Resources will flow towards that area, and they'll be wasted. So how might prices become inefficient? This is when demand for goods might become irrationally high, which results in a bubble. So there's talk about a housing bubble, and the question is this demand for housing irrationally high? And it results in high prices that attract too much resources into this particular sector. You don't hear about another form, so talk about bubbles is more common in the media, but you don't hear about the reverse, where you have a depression, the reverse of a bubble, where you have too few resources being drawn into the underpriced sector. But both are inefficient. So once it's recognized that prices are unjustifiably high or low, there's a correction which can be painful. And we'll see shortly people are saying there's a bubble in the housing market and the correction will still come, and then people will really get what they deserve. So how efficient actually are markets? It's an important question for investors and policymakers. So let me just give you some implications about why, and then we'll talk. There are two views. One is this notion that markets are efficient. So if markets are efficient, there's not much point in you spending a whole lot of time in analysis. You might as well randomly select a group of stocks and invest in that random selection. Or why bother doing it yourself? You can get someone, even an animal over here, to throw darts at the board and pick that selection. That'll be just as good as yours. It'll be random. On the other hand, you have people who think that markets are inefficient, and so prices can be unjustifiably high or too low, and you can have bubbles coming up. So this whole sense of market efficiency has spawned an industry of index funds. This is where people decide it's not much point beating the market or trying to attempt to beat the market. Let me just invest in an index fund where I invest in a broad array of stocks and simply take whatever the market gives me, because the prices must be right. So kind of person who's bought into this idea is Blaine Lewd, who's once a self-loathing Wall Street stock picker. I'm not sure why the self-loathing is there, but anyway, there it is. And now his perspective has changed. So he now reads the sports pages and lets his assistant over there worry about the financial. So he's reading the Wall Street Journal, and he's just reading the sports pages. Is he right to do that? So I talked to you about last week about these professional fund managers who can tell a story. And I spoke about the way they dress, the way they stand, the way they look. They're spinning a particular story. And they're quite successful, except that in spinning the story, they're not so successful in actually beating the market. So we see that the active fund management community has struggled to convince investors that they can actually beat the market because most active managers failed to deliver. The majority of them lost money in absolute terms and delivered returns below the index. And this is a finding that comes up time and again, which is why Warren Buffett says you're better off putting your money in an index rather than trying to beat the market. But it's also got some macroeconomic implications. If you think that markets are inefficient, then you'd agree with John Maynard Keynes, a famous economist, who suggested that the government ought to intervene when there are bubbles or when there's a depression. On the other hand, you have von Hayek, British-Austrian economist, who said markets work best with minimum government regulation. So if markets are efficient, then trying to interfere with the government interfering directly, will simply pollute the particular signals that the market is sending. Keynes' view is based on this notion that, things, basically there's a large element of irrationality, that the valuation of long-term speculative assets is substantially a matter of convention, just as it is with judgments of facial beauty. So his famous analogy is that the stock market is like a beauty contest. People are just trying to work out which is going to be the stock that is held in the highest regard by everyone else. So why does the debate matter? And so the debate matters because, again, in terms of a particular example of a policy, if you think there's a bubble, a housing bubble, then maybe the government should intervene to prevent this bubble. They should somehow stop the supply of housing in the market. So what is a bubble? So bubble is a fundamentally unsound commercial undertaking accompanied by a high degree of speculation. I'll tell you something straight up. I don't believe in bubbles. I don't think there's a proper economic definition of a bubble. So when people say, do you want a bubble? It says, I don't think there is. So if there isn't a sensible definition, then you can't believe in a bubble. Now that seems a fairly extreme thing. You can say, why? What kind of person doesn't believe in a bubble after all these crashes? We'll go through the reasoning then. I don't mind if you want to continue to believe in a bubble. That's perfectly fine, as long as you know the reasons why some people don't believe in a bubble and others do. There. So how efficient is the market? What do leading economists think? And this is the point I made earlier. I said this is an area where there is some considerable debate in finance. So even when I say I don't believe in a bubble, last year I went to the American Finance Association and there was a split. Some people said, of course there's a bubble, these are the leading economists, and others said, no, there isn't. And this split you can see this split illustrated over here. In 2013, Eugene Fama, Lars Hansen, and Robert Shiller all won the Nobel Prize for their work in asset pricing. They had different components, different contributions to our understanding of asset pricing. Fama and Shiller are more famous than Lars Hansen, so I'll just focus on them. According to Fama, he says he believes in efficient market. He thinks that markets are efficient. He doesn't believe in bubbles. Robert Shiller, on the other hand, thinks what Fama has said is the efficient market hypothesis, or at least one of the arguments for it, is one of the most remarkable errors in the history of economic thought. Tell us what you really think. This is the people who got the Nobel Prize the same day by the same committee. It's like, someone pointed out wittily, it's like awarding the physics prize jointly to Ptolemy for his theory that the Earth is the center of the universe, and to Copernicus for showing that it is not. That's how dramatic the difference is there. The Economics Nobel Prize Committee often does this kind of a thing, or does it more often than you'd realize. So those are academics, although they're doing well enough. They each have their different funds. But let's hear about what Warren Buffett has to say. So Warren Buffett thinks, he doesn't think much of it, of the efficient market. So he says, economists are economical with ideas. They made the ones learnt in graduate school last a lifetime. And university finance departments behave similarly. So they still think that teach the theory of efficient markets all through the 70s, 80s, and here we are, 2019, and I'm still teaching you the efficient market hypothesis. Other people then, they say it's the evidence. They look at the same evidence and they think markets are efficient. And this is Robert Lucas. Another Nobel Prize winner says the reason for the financial crash in 2008 is because of this belief in the efficient market hypothesis. Okay, you get the general idea, right? So, the question is, what do we do with this? Where do you land on this? And so my take on this to you is to suggest that when you get smart people, very smart people, who spend a lot of their time thinking about this question, there's no need to think one is a crank or the other is not That's an easy thing. That solves an intellectual tension within you. You can sort of say, people who don't believe in market efficiency are just, I don't know, they're just nuts. And those who do, they are. But that actually resolves some psychological tension without really helping you understand much more. So what's more difficult is to actually think about and consider both of their arguments and come to grips with them. And that's what I'm trying to, that's what I'll try to help you to do today. So I don't really mind whether you think the market's efficient or inefficient or whatever, and you won't be marked on that. You'll be marked on whether or not you think your understanding of the arguments for and against. Similarly, for your assignment, I really don't care what your final conclusion, where you think the best place to invest in the lithium market is, but simply how you arrive at that particular argument. Okay, so in thinking about this, let's make sure that we're looking at the evidence in the right way. So this is an economic perspective on this, and we see that I want to make sure that if prices go up and down, we don't automatically say that's a bubble. And similarly, we want to make sure that we understand that the high return is associated with high risk in competitive markets. And also the last proposition, it's hard to accurately predict changes in supply demand, and so it's hard to predict changes in price. So have a look at this hotel room in New York by day of the week for each month in 2014. In February, you can get a room for between $210. In October, you'll get a room, you'll pay as much as $340. Ooh. Inefficient market. Same product, different price. No. The price is fixed, demand changes, and so you see the price responding to demand. So there's no market. No one talks about a bubble in New York hotel room prices. Similarly over here, we have this couple, which I've spoken about earlier. They bought a house in Port Hedland when the peak of the mining boom. When the mining boom went out, the prices went down. That's the laws of supply and demand. What about this one? This seems a little bit more, so something closer to home for you. This surely must be an inefficient market. We have a $200,000 a year mine worker, James Dennison, heavily tattooed young man who dropped out of school. Didn't even bother going to uni, didn't even bother finishing school. He started in the mine 7 years ago, earning $100,000, owns a sky blue Chevy Ute. The price on his dog is $1,200. Yeah. If you get a $200,000 job when you finish, graduate, congratulations, you'll be doing very well. But he dropped out of school. Surely this is an example of an inefficient market. The clue is, the date is 2011. The price per tonne of iron ore in February 2011 was $185. The cost of iron ore producers was between $40 and $70. An enormous profit margin. So if you're a miner in that situation, what do? You think, whoa, I want to get the ore out as fast as I possibly can. This kind of profit margin you don't see, you see once in a generation, once in a lifetime. So you throw everything at it. You hoover up the university graduates, but then after a while they run out. There's a limited supply. So then you go to the next level. So you end up paying $200,000 for a mine worker who's dropped out of high school. Is that irrational? He mightn't be very productive, but you know what? As long as it gets anything out of the ground, you're making this kind of a profit margin. And you know that this is going to last long because other people are seeing these prices and they're going to come up. So that's the market working. The best predictor of a low price in mining is a high price in the commodities business, because you know that the market will respond to a high price by producing more. So see that iron ore fines price has gone up. It went to 180, then there's an extension of mining, and then it's come down. So these are the iron ore production costs. So this is from 2014. Over the next 5 years, iron ore prices are projected to average between $90 and $95 a tonne. And so on Friday, the March 29th, the iron ore price traded at $86. So the debate on market efficiency then is about this cash flow. The debate on market efficiency is whether or not prices could possibly be the expected, whatever the right cash flow is, discounted by the appropriate rate. Now, Robert Shiller says, he's a skeptic about this, and he says, well, this is crazy. I mean, you're third year, and you might get your head around but most people aren't third-year economics graduates or finance people, so they're not doing discounted cash flow. 90% of the people don't even know what this concept is. They're not doing any calculations. And the theorists then say it's not like everybody's behaving, but the market is behaving efficiently because people are getting expert advice and money management there. His argument is the market can't be efficient because if people are really doing this, then prices wouldn't fluctuate so much. So this jagged line is the actual stock price. And the line over here, the smoother line, that's the real dividends discounted at an appropriate rate. And he's saying, well, if you look at this, there are wild fluctuations in real prices which don't seem to match the changes in real dividends. So the market can't be that efficient, is his point. So how could it be that the market, so if people aren't making these calculations, how could it be that the market is efficient? So just to make sure what we're getting right here is, we're saying that the market has more information than any one individual. What I'm saying is that the interaction of all these people buying and selling results in a market price that is better than the educated calculation of someone as smart as Einstein. I don't know whether Einstein gambled in the market anyway, but you get the point. Yeah, so substitute any smarty for Einstein. The efficient market hypothesis is based on the theory that the collective trades of these people results in a price that is better than, more accurate than any individual can be. In fact, none of them need know the true price. To give you an anecdotal illustration of this, so we have a famous figure in history, in particular English history, Sir Francis Galton, who's a member of the British aristocracy, or at least the upper class, and a relative of Sir Charles Darwin. The big thing back in 1906 was this notion of universal suffrage, giving everyone the vote. And people like Sir Francis Galton were a bit cranky because they thought, no, you shouldn't give everyone the vote. The people aren't deserving of the vote. Now then you elect people like Donald Trump, someone like that. Yeah. So if you, rather than giving it, you should just give it to a select group of people. Like people who are smart, like myself. That's him talking. Or people who own property. If they own property, at least they must be smart. And in fact, we'll go more than this. His issue was the wrong kind of people were breeding. The lower classes were breeding too fast, the upper classes weren't, so he was in favor of eugenics, at least making sure that the right people were born. Anyway, that was a fairly common, it wasn't just Nazi Germany that had this philosophy. All through Europe around the turn of the last century, this was a fairly popular movement. The thing about Nazi Germany is that it killed it. But he was an empiricist, so having invented regression analysis, he decided he needed to gather some data to prove his point that the common people couldn't be trusted with the vote. So he was walking through Plymouth Fair and he came across this weight judging competition where he found this competition where people had to guess the price of an ox. So he thought, here's one bit of evidence I can use. I'll show that if the the average guess will be so wrong, and this will be a bit like politics. When we elect politicians, it's similar to this. We're just asking everyone to have a vote, and it's going to result in the worst candidate. So he collected all the guesses. There were over 800 participants, and this is before the calculators. Then, put it all in a spreadsheet and paper, and then took the average, and the average guess of the crowd was £1,197. The actual guess, and to his credit, he reported it accurately, the actual guess turned out to be 1,198. Pretty close, huh? You get the same effects. So in some finance classes, the lecturer will come in with a jar of jelly beans, and he'll put it up there and say, can you guess the price, number of jelly beans? And then they'll do an average, and then it comes out to be pretty close a lot of the times. How does it work? It works because although no individual has the right answer, some guess above, some guess below. On average, their guesses cancel out, and you get to the right price. So this is the point about Hayek. He's pointing out that markets, prices contain more information than any single individual. So if you want to read more about this, I recommend this book and this other article, Prediction Markets. So prices are generally accurate. Markets work, so people agree. So all economists are pretty much in agreement about it. No one's saying that markets are wildly inefficient. So even Robert Shiller says markets work well most of the time. And the question also is, what would be the alternative to market prices? Who's going to determine prices or direct resource allocation? The more helpful question to ask is, how frequent and important are the times when market prices are systematically biased? And this is a quip that Farmer made when we talk about market inefficiency. Someone says, he gave them a thing about market efficiency, and someone said, this is only a big example of market, and he said, this is only the tip of the iceberg. And Farmer says, the tip of the iceberg or the whole iceberg? Because he's pointing out that this is actually, you can give examples, but really they're not economically significant. So what are the theoretical foundations for the efficient market hypothesis? So in ascending order of sensibility or reasonableness, the first one is investors are rational and value securities rationally. No one believes that. Everyone believes that investors are often irrational. But then, even if the next argument is that even if some investors are not rational, their trades are random and they cancel each other out. And the final fallback is, when that defense falls down, people say, well, even if a lot of investors are irrational, then the smarties will come in. And they'll trade so that the noise investors, which is a polite way for saying the dumb investors, are eliminated. Because they'll be buying when it's too high and buying when it's too low, that kind of thing. So irrational investors money and cannot survive in the long run. The point here is that we don't expect markets to be wholly completely efficient, because there has to be some gains to searching for information. So there's always a level of inefficiency to reward those people who spend a lot of resources collecting information. And so you have Farmer's famous typology of market efficiency, where you have weak form efficiency. So looking at the price patterns of price changes you can't profit. Semi-strong efficiency, prices reflect publicly available information. So you can't make a riskless profit by poring over analyst reports, because this is already in the public domain. And strong form efficiency, where prices reflect public and privately available information. Now, no one believes that markets are strong form efficient, so the question is really around this area here. And some people argue that markets are in fact even weak form inefficient. But this is where most of the action is, the semi-strong form efficiency. So you have here an example here of, I guess, the semi-strong efficiency or strong form efficiency, where this is a British TV series where a cleaner in a stockbroking firm cleans up in the financial market by trading on insider tips from her cleaning pals across the city. So this would be somewhere between semi-strong form and strong form efficient. It's that. Now, one of the things here is this, people talk about, I believe that markets are semi-strong form efficient. Okay. But an issue that people don't pay enough attention to is this definition between information versus noise. So to illustrate this, let me give you an anecdote from my experience here. So every now and again, I'm asked to be an expert witness in a court case, and the court case is typically on the release of information to the market. So the people that come and they say, well, this firm didn't release this information to the market, and therefore the investors suffered some loss because under the continuous disclosure laws, they were meant to release this information, they didn't, and therefore the investors suffered a loss, so we're suing the company. But you can only sue the company. It only is worthwhile. It's one thing to prove that they didn't release the information, but the next thing is, did the investors suffer any loss? So the defense is, well, true, we didn't release this information, but no one suffered any loss because the markets are efficient. So we should have, but we didn't. But it doesn't matter anyway, because markets are efficient. So they asked me, so do you think markets are efficient? I said, yes. You think, how efficient? I said, fairly efficient, semi-strong form efficiency, efficient. And then they say, oh, okay. So it really didn't matter that we didn't release this information because it's already reflecting the share price. And then I say, no. Because what was released is in a different source was news. When something is released in the public domain, it doesn't make it information. It's a news, or it's a rumor, it's a fact. But information is something that you can rely on that is credible. So if the firm releases this information or news, it becomes information, whereas another source doesn't. So that's why it's important for us to have audited financial statements and official releases of information by the firms, because that's when people know they can rely on it. That's what makes it informative. That's what makes it news. So otherwise you have this publicly available information. Here you have a website designed to resemble Bloomberg, published a phony story that Twitter had received a $13 billion takeover bid, sending the price of Twitter up. And then later was found out to be false, but clearly someone had made their money in the interim by selling their shares that they'd bought. So just because it's in the public domain doesn't mean it's information. That's a fairly clean-cut example. More typical, and this is the kind of issue where judgment has to be applied, is you have a situation where you have the Reserve Bank Governor Chris Kent saying bond markets are underestimating the risks of wages growth. Now, that's his view. Is that information? Or it could be that what happened the next day is that, in the next week after, is that bond prices fell even lower because people are thinking, no, we're expecting a recession. Or the bond market seems to be expecting a recession. So that's where the judgment comes in. That's where you can make some money, but it's risky. It's not obvious that this is information that is without any risk. A third example, here you have the same report released by the Bureau of Resources and Energies Economics, and you have two people, one paper saying Australia predicts a fall in iron ore, Bloomberg News saying biggest export Australia boosts iron ore forecast in China. Same report, different interpretation there. So what then are the theoretical challenges to the efficient market hypothesis? So the people on the other side, those are the arguments in favor of the efficient market hypothesis. On the other side, they say, well, investors aren't fully rational. They react to irrelevant information, they fail to diversify, they buy and sell too much, they sell winning stocks and hold on to losing stocks. These are all examples of behaviors that lose their money. Investors' biases are systematic. They don't necessarily cancel out. So if you're over-optimistic, then it's likely that everyone else is also over-optimistic in general, or a large proportion of other investors are over-optimistic. So it's not like their biases cancel out. And then importantly, there's a limit to arbitrage. Okay, I'll stop here because this is a little bit tricky, and it's not that tricky, but it's just a good time to stop, and we'll come back at 5:02. Okay, during the break, I had a question from Innocent over here who asked me something that, a good question, and he said, if you don't believe in a bubble, then do you not believe also in the reverse, that assets can be underpriced? Which got me thinking, and I was thinking, well, logically, if I don't believe assets can be overpriced, then I shouldn't believe that assets can be underpriced. And so just to be clear about I think what I believe is that conceptually there is the possibility of a bubble, but identifying a bubble at any one particular point in time is very, very difficult. So I don't think that notion is particularly helpful. So I guess that's what I mean by a bubble. Bubbles can, in principle, exist, and maybe they exist in practice, but identifying them is extremely difficult. So I don't think it's a helpful conversation to talk about bubbles. And the thing about a bubble, why it's not helpful, is that it closes off. When you think something is a bubble, you sort of think it's irrational, and then you fail to look for other explanations for that bubble. You fail to look for the supply and demand forces that could lead to that bubble. So it's more that it cuts off your thinking. You think, it's a bubble, it's rational. I don't need to analyze it. That's why it's not helpful. I'll illustrate that with an example shortly. So just to go back to limits to arbitrage, this is the third limb of the argument over here. So this third point is that the argument that if there were dumb investors, noise investors pushing up the prices, the smart investors, if prices are too high, the smart investors will keep on selling their stock to the dumb investors, so that'll bring down the price. If it's too low, the smart investors will keep on buying up and driving out the positions of the noise investors. So the arbitrage argument is based on two propositions, that if there's a deviation from fundamental value, that's some kind of mispricing, there's an attractive investment opportunity. And then the second proposition is that rational investors will snap up that opportunity. So Shiller says the first proposition is right. If there is an attractive investment opportunity, once there's a deviation, rational investors will pounce. What's wrong is that what's not true is that every time there's a deviation from fundamental value, an attractive investment opportunity is created. He's saying a deviation from fundamental value doesn't mean there is an attractive investment opportunity. Why not? It's because that when you try to exploit that deviation to try to capture the benefit, you'll find that it's risky and costly. And the risk and the costs prevent the market from responding so that the prices come back to their true value. So the mispricing, therefore, can remain for a considerable period of time. And what are these kinds of risks? So there are three risks: fundamental risk, noise trader risk, and the implementation costs. So this fundamental risk is the news that the bad news may emerge that cause an underprice to become even further underpriced. This is an example I gave this morning. I was just thinking, I can't think of a better. There must be better ones, but I'll give this one anyway. Last weekend there was an election in New South Wales. As the sitting government came back very comfortably, but leading up to the election, the contender, the opposition party, looked like they were in a very good position. So if you're a betting person, you might think, there's an arbitrage. Here's I can capture this, and I'll bet on the opposition party. And then in the last week of the campaign, there came some news that caused the party to implode. And so the government was returned comfortably. So the argument here is simply that this underpriced, some bad news, they were always the underdog, but then some further bad news came up that pushed the price out. That's always a risk that you face. The noise trader risk, so this is this notion that the mispricing may worsen before it gets better as a result of uninformed investors dominating the market. To give an example, a few years back, 5 years back, a friend of mine decided that the Perth market was way overpriced, and decided to sell and rent his apartment or go into the rental property. He kept it up for about 2 years, and then finally the prices kept on increasing and they broke and they went back into the market. That's because he thought, I think it's overpriced, but prices keep going up. If I keep staying out of the market, I mightn't be able to get back in. So, as it happened, he proved to be right, but it was a bit too late now, so he's already back in the market. So, this is the problem, that the markets can stay inefficient for longer than you can remain solvent. And this is the risk that fund managers face, or they claim to face. There's a separation of brains and brawns. They're the brains and capital. They're the brains. You provide them with the capital. And they're right, or they claim that they're right, but it's just that the market is too dumb to know that they're right, and so it keeps on bidding the prices up or mispricing. So there's that issue. And then this is the implementation costs. An example of an implementation cost is when a hedge fund becomes too successful and becomes very big. And because it's so big, people begin to follow it, and the weight of its trading moves the share price. So they try to capitalize on a position, they try to buy an underpriced stock, but the weight of their purchasing, people look at them and it bids the price up. So there's a limit to how big you can grow without affecting the markets, which is one reason why successful hedge funds will often close off their funds to new money, because they don't want to become too big. Yeah. So the other thing is that this last bit is we need a model to identify what the right price or return could be. The mispricing could be due to shares really being mispriced, or could be that the market price is right, but our model is wrong. And this is what's known as the joint hypothesis test. So 3 things, though, seem clear. This is very difficult to conclusively test market efficiency, because we don't know whether it's the model that's right or the market is right. But people agree that markets work, but there are also persistent pricing anomalies, which I'm going to show you shortly. But these pricing anomalies don't seem to be exploitable to an extent, or the extent to which they're exploitable is debatable. It's risky to exploit these. There. So let's go to some examples of this. One is BHP. BHP Billiton has shares listed in Australia and in the UK. So there's a London listing and an Australian listing on the ASX. The same company, same board of directors, same dividends, same risk, same cash flows. If the market's efficient, you'd expect the price to be the same. But you see that BHP's London and Australian listed stocks are different. The London stock sells for less than the Australian stock. So which means that if you want to buy the shares, which share would you buy to get the higher return? I'm not going to tell you the answer. You should know this. Or ask your friend if you don't know. So one is, BHP shares, Australian shares are more expensive. There's a clue. And so the question is, why don't the arbitrage people get this right? Why, if there's one price and there's arbitrage in the market, why don't they simply converge? So that's the violation of the law of one price. And it's not that's one example in the Australian context, but there are there are several other examples in different markets. Another anomaly seems to be this momentum. Momentum is this notion whereby if the winning stocks, if you see a stock that's going up, then you buy it. You'll buy it because it keeps on going up in price. So you're buying on the momentum. Some people don't think much of momentum. So Anton Taliaferro says, he says, make sure you buy value and not momentum. Make sure you're investing, not speculating. buy something you understand, and are prepared to hold as a source of income, not to make a quick buck. My take on this is, if it can take you 2 minutes to make a quick buck, take it. There's no virtue in waiting a year to make $100. You can make it in 2 minutes, make it in 2 minutes. So if you can profit from momentum, you know, this isn't a thing about your virtue, buying and selling stuff. You're buying and selling stuff. You know. How quickly you make it doesn't make you a better person or a worse person. But, so the question is this exploitable? So what you do is the people have tested this hypothesis. At the beginning of each month, they rank securities in descending order of their returns. So the top one comes first and then the lowest ones. The top portfolio are the winners and the bottom portfolio are the losers. So what you do is you short sell the losers and you use the proceeds to buy the winning stocks. And so you end up with a 15% annual difference. So a $40,000, now that's a bit low. I should update this slide. You can expect to get more than 40,000, not 200,000, but 40, somewhere maybe 50, 60, between 50 and 70,000. I'm guessing. But that's how much it'll grow to by 21.5 million. The point is it credible that such high returns can be earned so easily? Everyone knows about it. It's hardly any secret. So capturing momentum effects can be difficult. So some explanations for this maybe just reflects risks. Maybe the people who find this effect aren't controlling properly for risks, but there hasn't been any explanation. It seems to show up in the academic literature, and so here's a strategy for you. If you see a group of stocks going up and you want to make a short-term dollar, this could be one strategy. It's not a guarantee, it doesn't always work, but it does seem to work some of the time, a lot of the time. Now, don't be too greedy, because it reverses. So if you keep on buying the winners, there comes a point when the price becomes too high, and then it reverses itself. So just... Another one is on orange juice futures. And I want to illustrate, I brought up this example to illustrate the importance of understanding your model, making sure that you've got the right model in mind, that you're understanding what's going on in the market before you conclude there's a market inefficiency. So Richard Roll, in 1984, Richard Roll is an original NASA scientist, is a rocket scientist who then came to finance. In 1984, he wrote a famous study where he looked at the orange juice future. He was testing market efficiency, and he decided to pick this particular market. He picked this particular market because it had some characteristics that allowed him to make fairly good tests of market efficiency. 98% of US orange juice production is geographically concentrated in central Florida. The only thing is the weather, whether it's a major influence. So if the weather's too cold, then it freezes, and then the taste for orange juice is stable, so the demand is stable. So if the demand is stable, and the only change is the weather that affects the supply, the price of orange juice futures should reflect changes in the weather. But in his study, he found that there's no factor that it can explain more than a small part of the daily price movement in orange juice futures. So for over 20 years, he wrote this in 1984, this was a puzzle in finance. So Stephen Ross, a big believer in the market efficiency, in a book on this, he referenced the study and said, this does seem to be a puzzle. The explanation for the weather is in the order of 1 or 2%. So the rest of it seems to be random variation. It seems like the market is inefficient. Except in 2007, another study came out where they found a flaw in Richard Roll's original study. He was looking at changes in temperature across the full spectrum. So he was treating a 10% change or 10-degree change from 30 degrees to 20 degrees the same as a change from 5 degrees to minus 5 degrees. Now, if the weather changes from 30 degrees to 20 degrees, it gets a bit cooler, but it doesn't affect the supply of orange juice. But if it goes from 5 degrees to minus 5, the orange juice freezes. And so that it becomes unusable. So when you look at the changes in temperature around the freezing point, then it suddenly all made sense. The market wasn't being irrational. The market was actually reacting quite appropriately. So just because we don't understand why prices move, it doesn't mean that they are inefficient, is the point. Which brings us now to stock market bubbles. So Shiller talks about bubbles. So he says where a news of a price increase, and this seems a plausible thing. So people think about a price increase as Bitcoin. You hear about Bitcoin, the price goes up. Everyone says this is a new coming technology. There are people amplify stories that might justify the price increase and bring in a larger and larger class of investors who, despite doubts about the real value of the investments, are then drawn to it. So you buy Bitcoin because you have basically FOMO, fear of missing out. And he goes on to elaborate on this, and he says bubbles aren't really about people being irrational. He says bubbles are really not about investors being crazy in any sense, just out of their minds, but really being sold a narrative. And this goes back to the point I made at the very beginning of my lecture. People are sold a narrative that seems plausible, and therefore they buy into this particular story. So, I mean, look at the Bitcoin thing, it seems nuts, but if you go back in time, 2 or 3 years back, it seemed, oh yeah, new technology, this could be worth, who knows where this could end up. To give you as an example of this kind of thing, where the narrative matters and the context, so Jennifer Hewitt writes an article where she says, I went to an auction in the very nice, expensive suburb of East Melbourne. Now, to put this into context, she's from Sydney. And the Sydney prices have been very high for some years. So she goes to Melbourne and says, oh, a 2-bedroom apartment at 1.7 million looks pretty good. And then she says, actually, what am I thinking? This shows how crazy I am how distorted my views are after excess exposure to panic conditions dominating the Sydney property market. In any rationally functioning market or mind, paying over 1.7 million for a 2-bedroom apartment should be thought painfully extreme rather than an example of restraint. This is the kind of thing in Sydney. The bidding opened up at 3.4 million for this, and then it went up to 4.2 million. And so you get stories where people believe this. So Mr. Cusino, who works in finance, started building his property portfolio. He says, I'm very optimistic about the long-term outlook for the property market. So what's his story? His particular story is a rising population around Sydney, about 100,000 migrants a year will continue to buoy demand, even if there are occasional price dips. He says, I've studied the markets, understand the investment cycles. I'm in the market for the long term. This is not 2 or 3 years. I'm talking 10 or 15 years. I believe it's a lower risk investment than shares, which is just as good that he's in for the long run because the prices are headed for a 10% dip right now. So, tulip mania. I want to point out something about, let me go to the most famous example of a bubble, and it's written by Charles Mackay in his book, Extraordinary Popular Delusions and the Madness of Crowds, where he said, by 1635, a sale of 40 bulbs for 1,000 florins was recorded, and by way of comparison, a ton of butter cost around 100 florins and 8 fat swine, 240 florins. So why did people think so? Maybe they were crazy. And these are other bubbles through history. So, right now, it's in what back, according to Lindsay David in the Sydney Morning Herald, we're in one of the worst housing bubbles we've ever seen. It's 40% overvalued based on price to income measures. This is 2016. But is it really? Or is it supply and demand? So this is Chris Joy, who writes in the Fin Review. And Chris Joy was my student at the University of Sydney, and this style of writing is very consistent with his persona. He's got a very forceful kind of persona, a very confident young man. And so he says, during the week I demolished one such doomsayer, a newspaper columnist called John Adams. Adams argued that Australia's elevated private debt levels mean we're destined to experience an economic Armageddon that will force house prices down by 40%. And yet, he said he was completely flummoxed when asked him to explain what factors will necessitate the deleveraging that precipitates this apocalypse. So, now, the thing about Chris is that although I think he could tone down his writing, but his basis, the way he approaches the analysis is quite appropriate. He says, rather than say it's a bubble, why don't we look at the supply and demand? What's bringing up the supply, what's keeping up supply is the US economy, he says, will continue to power global growth. And then people also overlook the question of debt serviceability and their interaction between the level of debt and incomes and interest rates. He's pointing out that we've had such low interest rates for so long that people are now able to support a higher level of housing prices. So the structural decline in the price of money as a consequence of low inflation has allowed the economy to safely service much higher debt burdens. So he says, despite the sharp increase in household debt-to-income ratio, the 9.1% share of income accounted for interest payments is not significantly different to the average, 8.2% average over the last 40 years. So his point is, unless we can foresee an increase in interest rates, a dramatic increase in interest rates, there's no need to fear a housing correction. Now that kind of makes sense. It's an argument that you can respond to. You can think, okay, there's a supply and demand. And it's pinning it down to specific factors. And we can see here that if one reason why there's no need to think there's an immediate danger of a housing crash is that the 10-year bond yield is at a low, which means that people are predicting future interest rates will be lower rather than higher. There's no risk of inflation. It doesn't mean it can't happen, but certainly one of the facts, it looks reasonable to think that there's not going to be a crash. So going back to bubbles then, one reason why Eugene Farmer talks about this, he says, people are talking about bubbles too casually. Every time prices go up and down, there's a bubble. So it says, most people would define, it says, it's easy to say prices went up and down, it must have been a bubble after the fact. I think most bubbles are 20/20 hindsight. So to give you an anecdote of what he means over here. Back in the 70s, one of my colleagues in the business school bought a house he was new to UWA, he was a young man then, and he bought a house in Dalkeith within walking distance. The house was, he went to the bank manager and asked for a loan, as he did. Back in those days, you had to go, you had to put on your best suit, but I think, convinced the bank manager. And I said 15,000 in this morning lectures, but I think it was 25,000. So the house was $25,000. And the bank manager said, ooh, you want to buy this house? You sure? He says, yeah, that's why I'm here in my suit to ask you. And he says, it's way too high. I don't think you should buy this house. It's way too high. The prices have got to come down. My colleague says, maybe, but I like walking to work, so I'll buy that anyway. So he did. And he lived happily ever after. Prices went up and up and up. Now, think about what the bank manager must have been thinking. There's a bubble. Back in 1970. Who'd have thought that in 1980? The bubble, it's going to burst back in 1990. At which point, he probably gave up and stopped thinking about that. So my point is, bubbles are when they go up, something called a bubble, and it stays up, people forget about it, and they ignore the talk of a bubble. But if it crashes, the bubble, I told you it's a bubble. Okay? That's after the fact. So that's the thing about bubbles. There's always someone saying prices are wrong, or too high, or too low, and those are the people that I told you so. But like a stop clock. So it says they have to be predictable phenomena. I don't think any of this was particularly predictable there. Have a look at Steve Keen. So this is the most famous or notorious thing. This notion of a bubble is more sociological than a financial phenomenon. People don't talk about bubbles in this market. The highest price of Brent crude in 2014, 115. Later was 45. There's a percentage change, was minus 61. No one says it's a bubble. Price for iron ore has fallen by 50% back in 2050. No one talks about a bubble. But you talk about a housing market, and people say, we are in a bubble. This is the dumbest bubble in history. And you know what? This is just due to greed. Not your normal garden variety greed, but a culture of greed. So the people who bought houses and their price went up, they're just greedy. They shouldn't be so thrilled with themselves or happy. It's just greed. The poor education, exercising the choice to remain dumb. And they're lazy. John Howard created a mass market of aspirant capitalists who were or are speculators in a zero-sum game. Again, you wonder what motivates people to write this. Why so annoyed? It turns out that tulip mania, although people took of the Dutch, is that it didn't destroy so many lives. In fact, the Dutch economy went on quite well. It's later on that people talked about tulip mania because they felt that the Dutch were obsessed with material goods, in the same way that people talk about the middle class here being obsessed with material goods, as though something's wrong with that. Similarly, Charles Mackay, he spoke about other delusions, but he didn't talk about his own delusions, and he didn't talk about the railway mania, which was another spectacular collapse, because the people who were involved there were people like Charles Darwin, John Stuart Mill, and the Bronte sisters, respectable people. They couldn't have been irrational. So there's always a diversity of views. How do you know who really knows from this? And so Richard Taylor says, so the opponent to when I spoke to Farmer, this is Cassidy, the reporter, John Cassidy says, when I spoke to Farmer, he said he didn't know what a bubble is. He didn't even like the terms. And Richard Taylor, who won a Nobel Prize a couple of years back, says, I know what a bubble is. It's not that we can't predict bubbles. If we could, we would be rich. But we can have a bubble warning system. You can look at things like price to earnings ratios, price to rent. These were telling stories, and the stories they were telling seemed to be true. Okay. If that's the case, let's have a look at this instance. Robert Jarrow. Robert Jarrow is a big name in finance, and he's written an article here with two other lesser-known academics, Journal of Portfolio Management. Back in 2011, he looked at LinkedIn's stock price, and he said, let's subject this to some tests. I think we've got a good bubble warning system. So they took their tests, they did some fancy statistics, analysis, and they said, we used our methodology to test whether LinkedIn stock price was exhibiting a bubble. We found definitively there was a price bubble. So this is 2011. The price of LinkedIn at the time was about $96. Can you see the crash? 2011 was 96. You can see the crash, right? It crashed all the way to 196. And then it was bought out by Microsoft. This was definitely a bubble. Really? You can't tell a bubble. So, if the smartest people can't tell there's a bubble, even though they think definitely they found a bubble, it's very difficult for other people to work it out. So there's two things. The price could be right. The model of what the price should be is right and the observed price is wrong, or a model of what the price is wrong and the observed price is right. So this is here, when we find something that we don't understand, maybe it's that we don't understand, or it could be that it's wrong. But deciding between the two, the data are consistent with both interpretations. So what we see is consistent with both market inefficiency and inefficiency. So Farmer looks at the data and sees efficiency. Schiller prefers to assume inefficiency. So the data here is, you see an old woman or you see a young woman. It's the same data. It depends on how you look at it. You can Google this if you haven't seen it. Okay, let's... I'm going to skip over this. I'm going to talk about this Stephen King on when the Australian housing bubble began. So again, this difficulty in predicting bubbles. So he dates the Australian house price bubble from 1998, when it was spiked by the introduction of the first homeowner scheme. So that's him in 2012. A couple of years later, he says, I apportion most of the blame for the Australian house price bubble to the finance sector. There's little doubt that the fuse itself was lit by the government intervention by the first homeowner scheme, which began in 1983. That's when your parents were at uni, sitting where you are, or whatever. Or later on, he goes on to say, the Australian nightmare has been a dream has been a nightmare. The bubble began right in the middle of 1964, when your grandparents met. So we've had a 50-year bubble, a 54-year-old bubble. Is that really a bubble? Does it make sense to talk about a bubble that's been around for 54 years? Okay, the last point I want to make is this one over here. There's a product disclosure statement which says, past performance is no guarantee of future results. That's true. But what it means, what we are finding out now is that there's also another statement, investors should note that past performance is not indicative of future performance. That's not quite true. If you have, and let me give you an example here, if bond prices are high, what's the prediction for future returns for bond prices? If the price of a bond is high, the expectation is that future returns are going to be low. So if house prices are high, it is indicative of future performance because it suggests that future returns are going to be low. There. Make sense? High prices, lower returns. So high valuations are on average followed by many years of poor returns, not vice versa. High valuations are not on average followed by years of good cash flow growth or by even higher evaluations. So this fact holds across markets. So what he means here is, if a house is selling for $1 million, rental income is $25,000, average disposable family income is $50,000. How do you assess whether it's overvalued, undervalued, or just right? So you can think, what's the ratio of rent to income? What's the ratio of family disposable income to house price? And let's say the house increases in price to $2 million. Do you expect the rental income to increase by 100%? Probably not. So the future returns are going to be low. The rental income is going to be low relative to that. Okay, I'll let you go. And the quiz, I think it's Pharma was this morning, so this afternoon it's French. Kenneth French, his partner. F-R-E-N-C-H, capital F.